Good morning. Well, welcome everybody. Welcome to our Crowder session about the tax implications of angel investing. I will give people a second or two to join the live stream. But while I do that, I'll welcome everybody and I'll do a quick bit of introduction from us and what this session is about. And then we'll dive into our questions for today. My name is Paul Clark. I'm one of the managing directors of Venture South. We're an investment firm that invests in early stage companies in the Carolinas. Periodically, we do an online session like this to do some Q&A about various topics relating to angel investing. We're using the Crowder TV platform today, and you can go back on our website and look at some of the previous sessions that we've done. Typically, these sessions involve just me talking to the camera, but for a bit of variety, and because we need some agile expertise on the team for a subject like this one, we're doing it slightly differently today, and I'm talking to Ben Glenn, who's a tax expert at Bourke Knight, Petras and Stormer here in Columbia, South Carolina. I'll ask Ben to do some introductions in a minute, but a little bit of housekeeping first to kick things off. So if you're able to watch this, then you know that we're using the Crowder TV platform. Crowder is an interactive Q&A platform, and the reason we're using it is so that we can take your questions during the course of this live stream and try and do our best to answer the questions that you want to hear the answers to, not just the questions that, the softball questions that I want to serve up to Ben for this session. So if you have some interest in some topics, if there's something that's not clear in what we're talking about, or if there's another topic that you'd like us to cover, please submit those questions to the Q&A functionality, which is on the right-hand side of your screen. Crowder is also a fundraising platform. It's mostly aimed at politicians and non-profit entities to help them fundraise by providing interesting content and helping them encourage their donors to donate to them. We aren't necessarily soliciting donations today.
We're not?
No, we're not. No. We're happy for people to donate if they would like to. It is linked to Venture Carolina, which is a 501c3 non-profit. So if you would like to donate, you're very welcome to. If you feel there's some value in some of the Q&A and these activities that we do, you're welcome to donate, but please don't feel that there's any obligation to do that. So that's it for housekeeping. You can do that contribution if you like by clicking the green button that's there in the middle of your screen. With that introduction, I would like to ask my first question to Ben. Actually, before I do that, I'll just do a quick disclaimer that although Ben is a tax expert and I'm definitely not a tax expert, none of the things we talk about today are really tax advice for you to rely on. If you're relying for tax advice on a video of two guys you saw on the internet, I think there's a problem. You need to talk to your tax advisor to understand the implications of some of the topics we're going to cover today on your own tax situation. So with that disclaimer, Ben, I'd like to kick off by just asking you to start with, can you introduce yourself to the viewers and give us a bit of your background and Bourke Knight, Petras and Stormer's background in the entrepreneurial space?
Absolutely. My name is Ben Glenn, and I work at Bourke Knight, Petras and Stormer. I'm a senior tax manager here. I've worked at Bourke Knight, Petras and Stormer for 11 years this October, and been a certified public accountant for about 11 years, but been working at CPA firms for about a total of about 16 years. And tax has been my expertise in all those years, no matter where I've been. Been involved with startup companies throughout my career, and in the past, I'd say 5 or so years, our firm has gotten very much involved in the startup community that's developed in Columbia, South Carolina, and throughout the state itself. We are a CPA firm that is headquartered in Columbia, South Carolina. We have around 60 staff, so we're a bit bigger than that. Number usually surprises people when we tell them the number of CPAs we have on staff, and most of that is professional staff, either accountants or CPAs. Admin staff runs around 5, so we have about 55 actual accountants on staff out doing work. We have clients across the nation, really. We have as far away as Alaska, as far south as Florida, as far north as Burlington, Vermont. We're involved with that many accounts. We're involved in several different industries. Niche industries such as captive insurance is one, telecommunications is one, and your standard manufacturing distribution centers is another. One industry that I'm involved with, and Tom Petras as well at the firm, is the startup community. We are a presence at the incubator here in town on a monthly basis, really just there to answer any questions that any local startups might have about accounting, about tax, about how do I set up my business, how do I set up my chart of accounts, how is this treated for tax purposes. And really what we'll do is we'll just go and sit and wait for people to come to us, and we'll meet a lot of good people, meet a lot of good companies. It's been a very interesting time.
There's probably no shortage of questions for you from
no shortage of questions, and they run the gambit from from the most basic questions, which is fine, because if you need help, the best thing you can do is ask a question. The worst thing you can do is not ask because you don't think it's a very good question. We're there to help, and we enjoy helping. Our firm serves around 15 to 17 startup companies that have come out of the incubator. Some very good success stories out of that. I have a grand opening this Thursday with one of our incubator clients that is grown and is opening a new facility. We have another incubator client that has had around 30 employees, I'd say 3 years ago, and now they have 250. So we have some very good success stories out of there, and it's a space we really enjoy serving.
Great. Well, we certainly appreciate your involvement in that space. Fortnite Peters and Storm is a sponsor of our group here in Columbia, the Capital Angels Investment Group.
Absolutely.
So we want to thank you for that, but also for your activity throughout the ecosystem. As you say, setting up companies is not easy if you haven't done it before, and you need to ask the questions of the people that know how to do it. And so we appreciate your willingness to help people do
Absolutely.
that. Maybe just to kick things off in the discussion here, maybe you could just lay out for us just the very basic ideas behind what you have to think about from a tax perspective when you're making an angel investment in an early stage company. Let's take as just as an example. So I'm an angel investor. I invest $100,000 in a C Corp company, and I sell it in 4 years' time. Where in that steps do I need to think about tax planning and tax issues along that way?
Well, for tax planning and tax issues, if you are investing in a C corporation, there's not as many, but because after you've made the investment, after you've actually purchased stock in the company, your basis in that stock is it's $1,000. Just to keep a small round number, $1,000. Your basis in that is going to be the $1,000 until you sell it, generally speaking.
Okay.
But the change in tax rates after 1 year and 1 day, after you've held it for a year and a day, is going to be, it goes from short-term capital gains to long-term capital gains. Okay. Short-term capital gains are taxed at ordinary income rate, which is your 39.6 right now is the highest individual tax rate if you're in one of the higher individual rates. And usually an angel investor and accredited investor might be a high wealth individual, high income individual that would need to be concerned about those upper rates. Yeah. After a year and a day, the rate drops from your ordinary income rates of 39.6 top rate down to the 15% for a top rate. Okay. And with some of the recent ACA Affordable Care Act, they've increased that top rate of long-term capital gains for high wealth individuals from 15% up to 20%. Okay. And then they actually add on another Medicare surtax of 3.8%, which is directly related to the ACA on top of that. So really your highest, I guess, worst case scenario tax hit, if you are for federal purposes, if you're for long-term capital gains, is the 18.8%. And then you have a couple, compare that to the highest ordinary income rate of 39.6.
Okay. And so most of the angel investments that we do last somewhere between 3 and 7 years. In that space, most of the time I'm looking at long-term capital gains.
Right.
Is there a nuance about if it lasts for more than 5 years, there's a better treatment? If your investment lasts for more than 5 years, do you get a exemption from capital gains in some situations?
Yes, in some situations, if it's qualified small business stock, which if it has to be C Corp stock in that scenario. It has to be original issue stock in that scenario.
Meaning the company has to sell it to me directly. I can't buy it from someone else.
Exactly. Right. Can't be in the secondary market.
Right.
If they have $50 million in assets, you hold it for 5 years, and it's original issue C corporation stock. Typically, you can exclude the gain. Should there be any gain, you can exclude the gain off of your tax return.
Okay. So in that case, I'm not paying any tax on the capital gain.
Right.
Okay.
Right. Well, you have state, but state tax. But yeah.
Right. And so does that just applies to, you said, qualified small business stocks? So
Qualified
as long as
small
it hits
business
those
stock.
criteria. And it's 50 million revenue in any given year?
No, it's assets.
Assets. Okay.
Yeah.
Okay. All right. So that's one nice facet about investing in an early stage company that doesn't apply to a lot of other things.
Exactly.
Yeah.
It's a very good benefit. And
Okay.
I've seen it a few times. I've seen it exclude some significant gain. It's September 27th, 2010. It has to be just after that date.
Okay.
So really, if you bought something that's just now coming to maturity and you bought it after September 27th, 2010, that's when you get that full exclusion. After that, there's some different percentage they apply, which is still a very healthy gain exclusion.
Okay. All right. So I make my investment in C Corp stock. I either have short ordinary income if I sell it quickly, capital gain if I sell it within 5 years, and then potentially this exemption of nothing if I sell it after that.
No, potentially, yes.
What if I lose my money on the investment? Obviously, angel investments are risky, and we lose money on deals reasonably frequently as an average across the asset class.
Right.
What happens then? What do I do with this nice loss that I've got?
Well, any losses you have can offset any gains you have in a certain year. But once you have netted your losses down to zero, the IRS only allows you to take $3,000 of loss on your personal return.
Okay. So above the netting. So if I made capital gains on something else and capital loss on my angel investment, I can net those and that 3,000 of
right. The most loss you will see on your individual tax return is $3,000, but you carry that forward. Right. The loss is carried forward.
Okay. This is the Donald Trump loss.
Right. Well, his was actually a net operating loss, which is even better. So he was offsetting. That's why he paid zero tax. Of course, you have to lose $1 billion in order to get this sweet tax benefit. But he had a net operating loss, so he was able to zero out all of his income, at least allegedly. I guess we'll say. I don't think we've all seen the tax returns yet.
Let's not the forum for discussing that. But yeah, okay. So at this point, I've either made a successful investment and paid my capital gains, or I've lost my investment and potentially offset some capital gains somewhere else. So obviously, the first scenario is much better. Let's talk about if we're making an investment in convertible debt. There's a lot of entrepreneurs come to angel groups asking to raise money through a convertible note. How's that different in terms of tax implications than investing directly in a piece of equity income?
Well, convertible notes are somewhat an attractive tool, but there are some cons that you need to be aware of. I think it might, in some instances, it's easier to do the transaction if you do it in some sort of a note that converts later. But just be aware that the clock doesn't start running on your investment in the company until it converts over to stock. So you might have had a convertible note that you put into the company 3 years ago. Yeah. Right. And so you're thinking, well, if it converts now and sells it, well, I've had it for more than 3 years. That means that I'm paying long-term capital gains. It's not true. Okay. You have to, the clock starts running on the day it converts over from debt into equity. Right. And that's when the clock starts running to a year and a day past that point is when it converts from short-term capital gain to long-term capital gain. Okay. Yeah, so that's an unpleasant wrinkle. It is, and you don't want to get surprised with that at the end of the day. Even on your worst case scenario, you're looking at paying double tax.
Right. And then during that period before it's converted, I'm accruing interest on that note typically. I'm getting a tax implication of that.
Yeah, definitely, potentially. We have in the case of guaranteed payments that are related to the use of capital like that. Yeah, those do get taxed to you even if you don't receive the money. I'm not getting the tax. You do get into some nuances that you need to talk with your tax advisor about as far as an accrual basis taxpayer and cash basis taxpayer and where all that would shake out. But yeah, that's definitely an issue that you don't want to be surprised with. We generally say to entrepreneurs coming to pitch to our groups, we're not going to invest in a convertible note for various non-tax related reasons for the most part. But particularly that capital gains clock question is one that it's a nuance to that note that we don't like. So we try to avoid investing in those to the extent we can. Yeah, and I always say you don't want to necessarily let the tax tail wag the dog necessarily. Right. But that is definitely an issue that you want to keep an eye on. Okay. I agree with that. Definitely.
Okay. All right, so I think we understand then the basic parameters of where we're thinking about or where we're likely to see tax implications of angel investing. Let's talk a little bit about some of the nuances about doing it in South Carolina versus other places. So first of all, on the capital gains, there's a capital gain for South Carolina, right? The state level capital gains tax as well.
Well, South Carolina has a really nice exclusion on the state level where you get to exclude 44% of your long-term capital gain. Everything gets taxed relatively at the same rate on South Carolina as far as any special rates go, but they do allow you to deduct. If you have a $100,000 long-term capital gain on your federal return, you will have a $44,000 deduction on your South Carolina return.
Okay.
So it's definitely a very good benefit. South Carolina is a very tax friendly state. Hopefully not to a fault, but I think we are a very tax friendly state.
So this is already a good place to be thinking about making long-term capital gains and angel investments. There's also a South Carolina angel investor tax credit. We get a lot of questions about this, so I want to spend a few minutes talking about that.
Yeah, absolutely.
Maybe just run us through the basics on what that is and how people go about getting it.
Yeah, there's a few steps you have to run through to be able to take this credit. It is 35% of your investment, limited to $100,000, which means the investing your total investment is around $284,000 to max out on the credit itself. But to get to that credit, there's a few hoops you have to jump through first. First, you have to apply with the South Carolina Secretary of State's office as a qualified business, which means you've been in business for less than 5 years. You are in a qualified industry, meaning that you're in manufacturing, distribution, tech, software, anything like that. Your gross revenue can't be more than $5 million anymore in any one of the prior years you've been in existence. Yeah. And if you meet all those qualifications, you apply with the Secretary of State's office, and they say, okay, you are qualified angel investor business.
Okay, so when you say you in this case, we're talking about the business.
Oh, sorry, yes, the company. The company qualifies to take the angel investing business, angel investments, and those investments would qualify for the credit.
Right.
Okay. But in order for your investment to qualify for the credit, then you have to qualify as an angel investor yourself. Right. Meaning you're an executive of the company, a director of the company, or you are an accredited investor. Right. Okay. If you qualify as an investor yourself and you make the investment, it has to be after South Carolina State. The Secretary of State's office gives you the go ahead. If you make your investment. If you make your investment after that qualification, even if it's a day after, there is no mechanism to roll back the clock.
So if you make the investment when the business has not yet got
qualified, when it's not qualified, there's no mechanism to wind back the clock and to make that investment count. Right. Exactly.
Yeah.
So once you've hit all those steps, then you get to December 31st at the end of the year. By December 31st of that tax year, you have to file what's called a TC 57A. And that form is, you have to apply for a tax credit now. So the business qualifies, you qualify, you've made the investment, and by December 31st of that year, you have to apply to the South Carolina Department of Revenue for your credit amount. And you have to give all who did you invest in, are you an accredited investor or director? Yeah. And you apply for a certain amount of credit, then you receive a letter from the South Carolina Department of Revenue that says you qualify for X amount of credits. Then you can file that on your actual tax return at the end of the year. So there's quite a few hoops you have to jump through in order to get there.
Right. But there are odd times too, because you're probably not thinking about making that application in December of the year before you're filing your tax return next April. Right?
Most every other credit that South Carolina has, you qualify for the credit just by the sheer fact of doing it during the year.
Right.
And then when you file your tax return, you just put the information on the credit form and you have it.
Yeah.
It's different in the fact that you have to make the application by the end of the year. And it's fair because it's by the end of the year if you're going to have the application process.
Yeah.
Because then you know what credit they have to be able to tell you in time to file your tax return what credit you have.
Right. Okay, so then in January the following year, you've got your letter that says you have X credit, and then how do you use that then in your filing? How do you actually claim that?
Well, you put it on the 57A is the application, the 57 is the actual tax credit form.
Okay.
and it'll be.
So you put one other form in with your regular tax return, and
exactly,
it reduces your
it offsets
tax
50% of your tax liability, up to 50% of your tax liability. It will carry forward for 10 years, and if you can't use it and you would like to, you can. It is a sellable credit. South Carolina allows you to transfer this credit only once.
Okay, we'll talk about the selling in a minute. I just want to go back to one thing you said. So this applies to angel investments, making investments as an investor, but it also applies if you're the person operating the company, right? If you're an executive or a director of that company,
right?
And obviously, a lot of people set up their company and put money in themselves as a founder,
right?
And I think people don't really realize that you can get that credit as a founder. If you put $10,000 in your business to get it started, $3,500 of that comes back to you from South Carolina's Department of Revenue if you follow the steps,
right?
And if you've got some South Carolina liability, perhaps from a previous job or something you're doing part time, to use it on.
Exactly.
That's an important thing that a lot of people don't ever try to apply for.
Exactly.
And that's money that could come back in your pocket. As a cash-strapped entrepreneur, you probably want to have that if you can.
Exactly.
So that's an important thing that I think people don't necessarily pick up. The paperwork sounds reasonably hard when you describe it, but it boils down to 3 or 4 forms. A couple of page forms. If you do them at the right time,
right,
it's a fairly seamless process, right?
Right. The hardest aspect of it is to make sure that you are qualified with the Secretary of State's office, and that as a tax professional myself, you can actually go to the Secretary of State's website and you can run a search, and they will tell you. They update this every day. They will tell you who is a qualified business, right? And you can actually make sure before you make your investment that South Carolina Secretary of State's office recognizes this company as a qualified angel investment company.
Right. Yeah. You should certainly ask that company for the letter they've got.
There too. Absolutely. You want to check all those boxes. Otherwise, that can make a very big difference. Very big difference.
Yeah.
If you're waiting a couple of days to make the investment, can make a big difference on your tax return.
Right. And so you mentioned the sellability, the transferability of the credit. Maybe just run us through why you want to sell it first, and then how you go about doing that if you wanted to.
Well, the main reason you want to sell it is you can't use it. If you don't have a South Carolina tax liability for whatever reason, maybe you have other losses, maybe you have out of state income, maybe you have whatever aspects on your tax return, you can't use it, or you can't use all of it. Maybe you can only use maybe a third of it or something like that.
Yeah.
But you'd rather have the cash in your pocket now, rather than let that credit carry forward and use it in the next 10 years.
So you can roll this credit forward for 10 years.
Right.
But you're saying if you don't envisage having a liability, a South Carolina income tax liability for the next decade, then you
right. Well, even then, if you'd rather have the cash in your pocket now,
right.
It kind of get into a little bit of a time value of money aspect of it as well. You'd rather have the money now than the money trickling in over the next 10 years.
Yeah.
But you can sell the credit, and when you sell the credit, it's considered a capital asset. And depending on when the credit was generated, you can get into some short-term, long-term capital gain.
Okay. So I'm selling my credit. I sell it for 85 cents on the dollar of the face value of the credit. So say it's a $5,000 credit. I can sell it for, let's just round numbers, $4,000. That $4,000 is potentially ordinary income to me if I sell it within a year of the credit appearing. Is that year of the day question?
Essentially,
Or if I sell it a little bit later than that, a long-term capital gain on that $4,000.
And on the purchaser's end, so on the purchaser's end, like I said, you're using 85 cents on the dollar. Okay, so you have $1,000 worth of credit that I'm buying for $850. Okay, so in that scenario, I'm claiming $1,000 of tax credits on my tax return that I only paid $850 for.
Yeah.
Okay. In this case, I would have short-term capital gain on the federal return for the spread between the $1,000 and the $850. So you'd have $150 of short-term capital gain on your federal return. So it's not. You have to make sure you do that calculation as well, just to make sure it's going to be worth doing. When you would do it at $1,000, it's probably not worth doing because you're not really saving that much money because of the tax that you're paying. When you get up into higher figures, you start to
potentially is
it becomes much more worth it.
But all of it is just paying a little bit of tax on a bigger gain. So instead of 150, you're making 125 in that example, depending on your tax rate. So
Right.
it's still potentially worth doing. It's not going to cost you money to do it.
Right. Yeah.
It's as beneficial as you might initially hope it would be.
Exactly.
Okay, got it. And we have a number of investors that are in our groups outside of South Carolina, so they typically don't have a South Carolina income tax liability, but they can get the credit first off, even if you're not a resident of South Carolina.
Well,
you just can't use it.
Yeah, and it's even a better example for who to sell the credit.
Yeah.
If you don't have a tax liability in South Carolina, then you might as well sell it.
Right. Okay. And we have had a number of people in our groups that have been through that process. Again, there are some forms to fill in, and you need to get permission of the Department of Revenue to make that transfer before you do it. So there's, again, some odd timing and some paperwork to do, but you can do it, and it's not all that hard. There's money in your pocket.
Right. Yeah. But that goes into, is it worth it as well? You know, the amount of effort you're having to put into it. So it's not all just the numbers at the end of the day. You can have to put some effort into actually make the transaction work. So if you're going to do it for this much savings, maybe you'd want to wait until you used it against a higher tax liability, also a higher tax liability.
Okay. And there's one other wrinkle to the tax credit that is maybe a bit too complicated to be talking about on a live stream. We might need a diagram to understand it. But there's this idea of a recapture at the end. If you make a capital gain on an investment which generated the credit, there's some mechanism for repaying some of that credit, right? Do you have any? Can you give us a quick summary of that, or is that just too hard to really talk about in this kind of?
I'm trying to think of a good way to describe that. That might be a little too in the weeds for the live stream. Yeah. We'll table that one. If
there's
a question,
if people want to talk about that, let's talk about that offline. It's a reasonably complicated process, and I don't think we know anybody that's been through it yet. So
no, I haven't seen anybody go through it themselves.
It's definitely something to at least remember to keep good records, because at some point, if you are fortunate enough to make a capital gain, or actually if you make a loss on that asset too, there may be some additional work to do to figure out what the implication of that might be.
Exactly.
Okay, so we talked about the angel credit in South Carolina. There isn't an equivalent credit in North Carolina. There used to be, but there isn't anymore. So I guess that's
North Carolina has been going through some big changes on their income tax side. And there's some credits they used to have that they don't have, and some credits that they have now that they didn't used to have.
Right.
South Carolina, I mean, I might be a little prejudiced because I do a little more South Carolina returns than North Carolina returns, but theirs are usually a lot more nuanced and difficult to deal with.
Okay.
Typically.
Okay. All right. So I'm going to have a quick look to see if we've got any questions coming in from potential users. We've got a question from Thomas, who asks, is the seed round the first $100,000 or something of investment tax deductible if the family and friends do not take equity in this round? Or no, do not take equality in this round. Not quite sure what that means. Perhaps he's asking, so as an early stage investor at a seed round, all of the stuff we're talking about applies, regardless of whether it's an angel deal or a family and friends round.
Right, stock is stock at the end of the day.
Yeah, so there's no real change depending on who that person is. But what about if you're the founder? So there's some different implications if you're the founder about some of the things we talked about, right?
Right. If you were the founder of the company and you materially participate in the company, we already talked about your ability to participate in the angel credit. But say the company, we've been talking about C corps a lot. A lot of times they'll deal with C corps because of the preferred stock angles. Yeah. But if it is a partnership, an LLC, and you materially participate in the company itself, I think we can get into this maybe a little bit more.
Yeah, let's talk about that. Yeah.
Okay.
And we'll come back, Thomas. We'll come back to your question in a second, because I think let's lay the groundwork on the LLC investment activity and pass through losses.
Okay. The LLC, as it differs from investing in a C corporation itself, you still have the issue of basis. In a C corp, we talked about you buy a stock for a certain amount of money. Generally, that is going to be your basis in that stock. You buy stock for $1,000, generally your basis is going to stay $1,000 over the course of the investment, and then when you sell it, then any gain or loss, it will be measured against that $1,000, right? LLC is a little different. Your basis, this will be somewhat a real general discussion of it. you put that same $1,000 in to buy your member units in an LLC. Okay, that $1,000, just like with the C corporation, that's your basis. But as you're allocated income or loss from the company, you're allocated income from the company. Say you had the $1,000. If you're allocated $250 of income, then and you pay and you claim and you report that $250 on your tax return, you pay tax on the $250. That gives you additional basis. So now your basis, instead of $1,000, it's $1,250 because you pay tax on that $250. Same example, except you got allocated a $250 loss, and you were able to take that loss on your tax return. So now instead of $1,000, it's $750. Mm-hmm. And also, what other items that will increase and decrease your basis are additional contributions. If you put another $500 in, mm-hmm. or if you take $500 out, your basis goes down by that amount. So on an LLC investment, you are measuring your investment on a year-by-year basis, and C corporation, you're never really told anything. Well, you know how the company did, but you're not reporting it on your tax return unless you get issued a dividend. Right. On an LLC, you are always going to get the Schedule K1, and the K1 will allocate all of your items of income or loss for you to report on your tax return. It will tell you how much money you put in, how much money you took out, and so you can calculate your basis on a year-by-year basis. Now, we were talking about founders a second ago, the difference between maybe a founder or any material participant in the company itself. Okay, on a founder or material participant, really just we're talking about material participant. We keep saying founders, but really you're talking about materially participating in the activity, which generally you spend more than 500 hours with the company itself. Okay. There are other measurement tools, but generally that's the main one to get over. Yeah. Are you spending more than 500 hours on this business every year? Yeah. Okay. In that case, you are an active participant in the business, and if you get allocated a loss, you get to take that loss as long as you have the basis. So you got $1,000 worth of basis, you get allocated $250 a loss. You get to take that $250 loss on your tax return itself. Okay. So
against anything that you might have.
It offsets any other income, right? To the extent you have basis, now you had $1,000. If you get allocated a $1,500 loss, you take $1,000 and the $500 gets suspended. Okay, so you're talking about basis and everything like that. Yeah. But as you talk about material persistence versus passive owners, a passive owner is, in general, one of your angel investors who has put money into the business and has no day-to-day activity with the company itself. Yeah. They just put the money in and want to see the business grow and hopefully sell and make a profit on it. Yeah. In those cases, that $250 loss is a passive loss, and you can only use passive losses to offset passive gains. I hope I'm not getting too technical.
No, that makes sense.
So if you have two companies you've invested in and they're both passive, and one had $500 worth of income and the other had $300 of loss, you would have a net $200 worth of income you would report on your tax return. Okay. Same scenario. You had two companies you were a passive owner in. You had one with $300 of income and one with $500 of loss. The $500 basically takes that down to zero, and you have that $200 left over. Carries forward. You can only use passive losses to the extent that you have passive gains. Okay. So if you have a company, and one more scenario, if you have two LLCs, it gets a little complicated. This is why people hire people like me. You have one partnership you were an active participant in, made $500 of income, and one that you were a passive owner in had $300 of loss. You're paying tax on $500, and that whole $300 carries forward because you don't have any passive gains to offset. So that's, I guess, the takeaway from that is don't invest in a partnership thinking that it'll be great. I'll be allocated these losses up front, and I'll just be able to take those losses on my tax return. Because it's not necessarily the case.
I think, most of the investors making angel investments into LLCs probably have some passive income from other stuff they're doing, real estate investments or some other kind of investment against something to offset this passive loss against. But not necessarily. So. Not necessarily,
yeah. You want to always have that in the back of your head, because you might have basis, you might have checked all the boxes, but you get that final hoop to jump through to be able to take the loss, and you're a passive owner and it all gets suspended and carried forward. That can be a tax surprise at the end of the year that you don't want to have. So when I'd say when you're making an angel investment, that's a good time to just kind of reach out to your tax advisor and let them know I made an investment in FYI, I made an investment in this company. How's this going to affect my tax liability? And they can kind of run through the scenarios with you.
Yeah, I think it's also important to keep an update on the different bits of angel investment you're doing.
Oh, absolutely.
It can get pretty complicated. So
absolutely, and there's tax planning opportunities that can be taken advantage of if we know. I mean, I keep a good open line of communication with my clients, but at the same time, it's a two-way street. And when something happens with the client, and such as making an angel investment, please reach out to your tax advisor and let them know.
Right. Okay, so to circle back to Thomas's question, the good news is, as a founder or a material participant, is you can use this loss in an LLC. You're more likely to be able to use it than if you're just an investor. But otherwise, more or less everything we talked about is the same as a founder versus an investor.
More or less, yes.
Okay.
That's fair.
If you win in a grant competition, does that count as income to a company? Obviously there's a lot of pitching competitions with startups,
right?
Grant writing,
right. Sometimes the devil is in the details on the grants themselves. Sometimes those can be deemed as equity. Sometimes they're income. Sometimes that money is used to and it is specified. It needs to be used to purchase fixed assets, PP&E.
Yeah, right.
So you need to really the devil's in the details. There's not one answer as far as how do you treat the grant you just received.
Okay.
If you went out and you won a competition and they said here's $10,000, no strings attached, then more likely that's going to be income.
Okay. So don't spend it all because you need to send some of it to the Department of Revenue.
You need to send some of it to the Department of Revenue.
Yeah. Okay. But if it's a grant competition or a pitching competition like that ends up in equity as an equity
investment, yeah, then it's that is
back to this question.
Yeah.
Okay. Exactly. Thomas also asks, can someone assign a scholarship for students who are helping startups while receiving hands-on experience and get a tax write-off? Any idea how you might answer that, Ben?
Maybe read that question again.
Yeah.
Can someone assign a scholarship for students who are helping startups while receiving hands-on experience in science, technology, engineering, math, and get a tax write-off? I think he might be referring to making he could be referring to making a contribution of sorts to getting a scholarship. If he's making a contribution to a university that'll go toward a scholarship for an individual, then it should be a tax write-off as a charitable contribution to a 501c3.
Okay.
I believe that's his question.
Okay. So the answer is yes, potentially, because to the right place.
Yes, any qualifications on that?
Yeah,
I'm not sure.
Right.
100% got the full details of his question.
Okay. Well, I think we're having a few technical problems with the question functionality, and maybe if people are watching, we tested this yesterday and it worked fine, and then overnight Google changed how Google Hangouts work. So we may not be getting the questions in quite the usual slick way that Crowder usually serves them up for us. So if you have any other questions that we haven't covered during this session, obviously please email them to me. VentureSouth.vc is the website our website that you can contact us through. So if you have questions for Ben, I'll happily pass them on to somebody who can answer them much better than I can. But if you have questions that we're not addressing today, then let us know. A couple of other quick questions, Ben. So R&D tax credits is something that we get some questions about sometimes, or payroll tax credits for hiring people. Can you give us just a quick synopsis of some of those, or a quick overview of some of those?
Yeah, R&D credits have been an interesting credit to watch over the past several years.
Yeah.
The recent PATH Act just made R&D permanent. If you're a startup type company, and you qualify under certain parameters, you can use the R&D credit. If you don't have any income tax, you can actually use them to offset payroll tax.
Oh, okay.
Which is a great benefit. That's sometimes that's the rub of an R&D credit, right? Because you're spending all this money on R&D, you don't have any income because our R&D expenses are wiped out.
Yeah.
You're actually in a loss position, so then you have this credit that you can't use. Right. So that's a very good benefit if you qualify and be able to use those for against payroll taxes. That helps an immediate need, and it helps startups. I think that was a really good change to it.
And that's a federal level tax.
That's a federal level, and there's a state level credits as well.
Oh,
yeah. But as far as R&D credits go themselves, it is the definition of what R&D is per the Internal Revenue Code. When you hear R&D, people think of men and women in white lab coats with colored water and beakers and those spirally glass things and everything like that. But that's not necessarily the case. Our firm has found a way to use those in the manufacturing process, because you might have engineers on staff that are redesigning a tool, redesigning something, redesigning the manufacturing process, and all that redesign work and all those salaries that go into that can qualify for the R&D credit. Okay. In telecommunications, we've some of our telecom clients we've secured probably over $1 million worth of R&D tax credits. In your telecommunications, you're like, well, that's not really R&D, but there's a lot of engineering work that goes into that. And so what they're able to go in and do is do a study of what you've done, allocate the salaries and supplies that were associated with your qualified research expenses, and it ends up being net effect around 6.5% R&D credit, which you're allowed to say.
Okay. Any limitations on where you are or where you are in the life cycle of a business to be able to get that tax credit, or does it apply to everybody?
Pretty much applies to everybody. There's some calculations you have to go through. So you want to, if you think you might qualify, it's definitely worth exploring. Yeah. Because a lot of people do qualify that don't think that they necessarily would. One aspect to be careful of is if you are a passive investor in an LLC. Okay, and the R&D credits, if they are taken in that scenario, there can be an AMT tax liability generated. AMT being the alternative minimum tax. AMT, just as a quick rundown, you start with your regular taxable income, then you add back what they call preference items. They make you take slower depreciation and a few other adjusted gain, but one of the items is your research expenses. Okay. Where if you took the R&D credit on it, you might have to add back not just the credit, but the expenses themselves and amortize those over 10 years. Okay. So that can actually be a very detrimental AMT hit. So you have to be very careful in a pass-through situation if you're receiving a K1 and you're a passive owner, that you don't get hit with that, because that AMT is hitting more and more people these days.
Something to be aware of then as an investor. But as an entrepreneur, there's no downside for you trying to find find these credits if they're out there.
Exactly.
Are there any others that we haven't talked about, either federal ones or state ones in the Carolinas that are relevant?
One particularly in manufacturing that I see a lot of is the capital investment credit. It used to be the economic impact zone investment credit, meaning that the Department of Revenue, chose certain counties in the country, in the state, who needed some extra economic investment. And so if you bought property, plant, and equipment, put those in service in those economic impact zones, you could get a state tax credit depending on the life of the asset. The shorter lived asset got you maybe 1% credit, then 5 get you 2, 7 get you, and the longer life asset gets you more and more credit. But that used to be only for economic impact zones. But now they call it the capital investment credit, and it's any county in South Carolina. So if you're a qualifying business, mostly it's going to be in manufacturing or telecommunications. We see a lot of that, but for the startup crowd, I'm not sure telecom would really apply, but manufacturing could. Yeah. that can provide a very good state tax credit.
Interesting. Okay.
You can't sell that one, but it's still a very good credit.
Okay. And is that one that the company takes, or that passes through to the investors?
It would pass through in a pass-through environment. It would pass through.
Yeah.
And they'll say, yeah, C Corp take it themselves.
Interesting. Yeah. Something potentially worth learning about.
Mm-hmm. Absolutely.
Okay.
That was a great one because it's easy to qualify for.
Hmm.
It's not like the angel and credit where you have to jump through all these hoops. All you have to do is buy the equipment, and actually your tax advisor or whoever's preparing your tax return, they have that information already, because you have to tell them the equipment that you bought anyway,
right,
in order for them to prepare your tax return. So it's just an easy credit calculation. You do have to reduce the basis of the asset in South Carolina by the amount of credit that you took. Okay. So you're depreciating at a little bit lower rate, but it's not a big deal at the end of the day.
Okay. I've learned something from this session.
Okay.
Okay. Well, I think that I think covers the topics that I wanted us to talk about. There's certainly plenty more materials, particularly on the South Carolina Angel Tax Credit, on our website, and I'm sure Ben will be very happy to talk to other people about that, because that's one where there isn't a ton of public information about it that goes really through the detail of the application process, right, or the nuance of how to sell it and the implications of that. So we've got a fair amount on that on our website that I'd encourage people to take a look at. And I'm sure Ben will be happy to talk to people about that too. It's part of your conversations you have with entrepreneurs all the time. That hopefully will become a bigger part of that as people get more familiar with it. Ben, do you have any other topics you think we've missed or would like to talk about?
One other topic, just really quick, I guess, to close it out with, is receiving a grant, is a grant, receiving a stock grant price.
Yeah, okay.
Right. As
an employee getting stock options, or a board member getting
as a board member, exactly.
Yeah.
So they might issue stock with a grant price of say $1, right? And it could vest at say $5.
Yeah.
And then if you were to sell it and then you sell it later at $10, just to give out a basic set of facts.
Yeah.
Normally, you would not pay any tax until you get into the investment stage, and then you would pay. Your capital gain would be calculated on the difference in between what you sell it at and what it vested at. So in that case, you're paying tax on the $500 of a spread between the 1,000 and the 500.
Yeah.
But there is an election you can make called 83B under 83B. And this is another one of those important timing issues that we talked about, similar to the angel credit. You have 30 days from the date of the grant to make this election, and you have to file a statement with the Internal Revenue Service. I would send it certified mail because you want proof that you sent it, proof that they received it.
Yeah.
That allows you to pay tax on the grant price instead. So you pay ordinary income at the grant price. And then when you sell it, you're paying tax on, in that scenario, the $900, but it's long-term capital gain. So you're at the end of the day, you're trying to get the most advantageous rate.
Yeah. And
so that 83B election, if you're the recipient of stock in a scenario like that, it's something you want to take advantage of. So that's just something else that for this community, I think should be aware of.
Yeah, I mean,
just in case
fairly frequently in this community.
It can,
so
and that's what
let me try to repeat that to you as a layman, and you tell me where I've misunderstood and where I haven't. So I receive a stock option grant for $1 a share. So for 1,000 shares, $1 a share.
Mm-hmm.
I can either make an election or not. If I don't make an election, I pay nothing now. Mm-hmm. But when I sell the credit, when I get that option at some point and I sell it at some point later, I pay ordinary income on
the
everything above
vested
vesting on the right.
On the vesting, you pay ordinary income at the amount of vested, and then when you sell, you pay tax on the capital gains on the difference between what you sell it at and the vested price.
Okay, and so if it vests at $5 a share, I'm paying ordinary income on $5 of value for 1,000 shares.
Right.
But I don't have to pay anything today. So later down the line, I have to pay this. Or I can make this election and I pay ordinary income today on the $1, and then long-term capital gains, hopefully, on the 9 spread between the 1 and what I set it for.
Exactly.
So I do have to pay something today,
right? But
longer term, I'm paying a much lower tax rate, so I'm paying long-term capital gains than ordinary income on the 5.
Exactly.
Right.
Exactly.
So I probably want to make that election if I think that this stock is going to have some
If
value.
it's gonna,
one
well,
day.
of course, yeah. That's always the
so
thing.
you've got to
You
factor
always
that
think
in
it's
too.
going to go up in value, right?
I mean, if you're joining a company as a startup and getting stock options, like you presumably do think it's going to be successful, otherwise you wouldn't join the company. So you typically want to make the selection, but potentially not necessarily if you can't afford that.
Mm-hmm.
You know,
Yeah, depending if it's more than $1. We're using dollars, but it could be a lot more than that.
Yeah. But typically I want to take the selection. Now I have to make the selection in 30 days. So as soon as I get the order, I need to start dealing with it immediately, not next time I fill in a tax return. Right,
and that goes into your conversations with your tax advisor. That's a very important one.
Yeah.
Because once those 30 days are up, there is no mechanism to go back in time. There's no relief from the Internal Revenue Service. Once that 30 days is up, it's up.
Yeah, they presumably want the income.
Mm-hmm. And it's not a hard election to make. It's not. It's a very easy election to make. It's just a standard form where you just kind of fill in the blank on a few different items.
Okay.
It's very easy to make, but if you don't make it, it can definitely hurt you tax wise.
Okay, well, that's interesting. So we have a seminar that we do sometimes on issues of being a board member, and so this is one of those where you need to at least do some planning if you want to join a board of a company. Right. This applies much more widely than that. So everybody that joins a startup perhaps isn't the founding team that have equity, but are the next group of people in that are getting share options typically to incentivize them. They need to know about this stuff from day one. So so think about it hard. Okay, well that's an interesting topic. Thanks for adding that to the list. There's myriad things to talk about when you're talking about tax.
We've covered a lot of bases today.
We've covered a lot of areas. So appreciate your time this morning, Ben. Thanks to everybody that has tuned in. Sorry if we weren't able to take your questions effectively today, but hopefully we'll try this again another time with some more interactive Q&A. If you have any questions, then please let us know. Otherwise, thanks for your time this morning, and we look forward to speaking to you again soon. Thanks, Ben.
All right, thank you.
Thanks. I'll just turn this off, then I'll shake your hand.